right, Shalom. Welcome to another Expert Inside interview. My name is John Golden from Sales Pop, online sales magazine, and Pipeliner CRM. Joining you as usual from actually a bit of a rainy San Diego today. And I'm delighted to be joined by Eric Fiegoli, who is on the other side of the country in New York City. How are you doing, Eric?
I'm doing great. Thanks so much for having me, John.
Yeah, absolutely. And Eric is the co-founder of Exbo Group. He co-founded this in 2017. And since the firm's inception, he's helped to provide finance, operations, and strategy support to more than 50 growth stage companies. It's easy for me to say. Eric focuses his time supporting clients' fundraising efforts as well as new business development. His areas of focus include software education, technology, and healthcare. Previously at Amazon, you were also at TD Securities and at Deutsche Bank. And what we wanted to talk today about is your experience about building Expo Group from the ground up. So, start off. You started this off as a bootstrapped company, right? So for people out there who maybe are starting company, who are looking at starting a company, just explain to them what is it like to start a company bootstrapped.
Yes, sure. So basically, when we, like most companies, Expo Group was really founded by accident. So we had started the business basically after some consulting engagement, and so really those initial consulting engagements were with a few growth stage businesses here in New York. They were sitting on top of their stack. But really didn't have any good direction or strategic leadership from the finance perspective. They may have had CEO, they may have had really strong engineers or other operations leadership, but really there was no one really in the front of the business driving things forward from a finance perspective. So our initial engagements really were focused around how do we help companies strategize effectively through financial forecasting, modeling, through building good historical accounting support so that they can take more of a proactive approach in terms of their growth strategy from a finance perspective. How do they take that information and use it more effectively to think about their path over the next 12 to 24 months? From some of those initial engagements, we got really good feedback. We were able to receive really strong support from a lot of the companies and started getting referred out to a few more businesses kind of in the space. A few other investors got wind of what we were doing and again started referring us out and some of our services to other companies within their portfolios. It was at that point that we really started to realize, okay, I think there might be a business in here. We're doing a lot of good work. We need to operationalize our own business and we need to professionalize the service because we're getting asked, I think there might be something here. And at that point, Kevin and I started to think about leaving our full-time jobs, which at that time I was working at Amazon as a senior product
Mm-hmm.
manager and Kevin was working in the advisory practice at Ernst & Young. So I'll stop there, but that was really the beginning stages of building out Expo Group, which was really founded and incubated from some initial consulting engagements.
Right, which is a great way to start a business because you almost, you had that proof of concept almost out of the gate, that you had the makings of a business. But looking back now, is there anything you would have done differently at the beginning?
Yeah, that's a really good question. We've made a ton of mistakes, of course,
Sure.
along the way. Mistakes with hiring, mistakes with strategy. I would say in the beginning, we tried to do too much, so we did not soon enough define what our areas of expertise were, and we certainly have areas of expertise, but we also were very broad in our approach. And because of that, we were doing things like helping create business plans, helping with legal entity formation, tax support, things where we honestly did not have areas of expertise. And I
Mhm.
think that being so broad, that hamstrung us a little bit and limited our growth. And once we focused in on more into accounting, finance, and operation support, that is really where we were able to kind of find our niche and find our core areas of strength. So I think that was a mistake that, we were able to correct, but I would say in the first year, first 18 months, we were just too broad, little unfocused.
Yeah, and I hear that a lot, and I think that's something we often talk about here on the show is about focus and obviously when you're starting a business early, I've done management consulting on my own in the past. Is sometimes you just take you know adjacent business because you're obviously you want to scale, you want to have some foundation, but ultimately it diluted focus. It's very hard to really establish yourself if you're too diluted.
Absolutely. And one other thing that we started to learn too is the more that you're focused, the more that you're able to build out proof of concepts and go to the market with those proof of concepts from a sales or business development perspective.
Hmm.
It's a lot easier to tell your story in a concise way when you have real areas of focus and strength. When you're so broad, it's really hard for potential clients to get a true picture of where you're an expert if you say you do everything. So I
Hmm.
think that was just a big learning on our part was really focus, and that allows us to really present ourselves as the experts that we are.
Yeah, and I think it's a great trust building thing too, is when you can say to your prospective clients, or this is what we do, and almost as importantly, this is what we don't do.
Yes, absolutely. And it's like, hey, we don't do this, but if you need help with this, we have great partners that can
Mhm.
support you. And then it makes us look good because we have partners that are lined up, or maybe it's a lawyer, or maybe it's an early stage go to market individual. And those people are going to be experts in their area, and we can connect you with them. But this is where we focus.
Yeah. So, I mean, if you think, okay, 2017, that's what, 8 years ago now. Is there, when you're working or when you're working with startup businesses or businesses who are in that phase, have things changed? Because the technology has changed. Like we have AI now. It's much easier to access, talent across the globe very easily, variable resources. There's a lot. Do you think things have changed in the way you can structure a business today and maybe scale a little faster?
Oh, absolutely. I mean, there's always a need for good quality professional services, people that are responsive, that understand what a client is trying to do. That is unchanged. Like
Hmm.
the service and delivery model is unchanged. I think for startups, the software stacks that they can use that are effective have changed considerably. Back in 2017, our operations, those were all much more manual processes. The accounting process was more manual. Now there's much better software that uses machine learning to help get you what you need. There's a lot better self-service tools as well. So it's a lot easier for business scale. Honestly, it's just cheaper and faster. For our team, we are a very tech forward organization, so we are always looking to adapt and add tools to our tool belt in order to support the growth of these companies, whether it is using software to help calculate metrics, whether it is the ideal software stack for working capital management, so like AR and AP management. We
Hmm.
certainly have preferred providers on the software side for HR and payroll, and we've seen a lot of good and bad options. So I think for us is like there's definitely a preferred set of softwares that we recommend to our clients. And to your question, it is absolutely just much easier. The table stakes, or the amount of time or capital needed to start a company it's just much lower at this point than it was even
Hmm.
only 8 years ago in 2017. And I think if you look back even further than that to like 2012 or 2010, it's just
Sure.
massively different.
No, no, 100%. And you're a profitable business, and I guess this is also, we've seen a bit of a change over the last while, where we've come out of the era where, investors and venture capitalists and angel
Yep.
investors and all of those were all driving hyper, growth, growth, growth at all costs, like top line growth, top line growth. Forget about profitability. And now it's switched over the last couple of years to path to profitability. But tell me a little bit about that. That's always a struggle sometimes, two opposing forces, two opposing mindsets, like growth versus profitability. How do you manage to do both?
John, you're absolutely right. We saw a shift, like the rest of the market in 2021, 2022,
Hmm.
that
Yeah.
coincided with the change in interest rates. We had a
Hmm.
period of time that was, let's call it a decade or about 12 years, where there was just cheap and easy money. And really, if you were going to take venture capital investors, their order for you was grow as fast as possible. Very, very little, I think, um, very, very little nod was given to, okay, what are you trading off for that growth? What growth
Yeah.
costing you? It was really all focused on top line revenue, and that was really a lot of our guidance to some of our venture backed clients. We also work with our team also works with private equity backed businesses, which are going to be on a different growth path and are many times profitable. We also
Hmm.
work with some founder owned and operated businesses, which are bootstrapped and often profitable as well. But for the venture backed businesses, um, just a huge focus on growth at all costs. And then we saw this major shift in the end of 21 and 22, where venture investors, or people in the growth space, are saying, well, you used to be wanting triple your top line this year. We're going to now shift to what can you get? What would you trade off? What would it cost us to trade off for doubling or growing top line 80%? Because we need to find a
Hmm.
path to profitability for this business. There's not just this endless flow of capital. You can't raise rounds on rounds. We need to be cognizant of what are we trading off for this growth. So taking all that into account, we now are providing our clients with a much more balanced picture about what they need to consider, how do they grow but grow efficiently. And it is hard because, you know, profit and growth are almost diametrically opposed. If you're thinking
Hmm.
about building and structuring a business towards pure growth, that is going to be a very different looking business than if you think about structuring a business towards maximizing profitability. So it's always challenging for companies to thread that needle and think about, okay, how do we grow this business but do it in a relatively capital efficient way? And that is really resulting from looking at key metrics, looking at sales efficiency metrics like CAC payback, LTV to CAC, thinking about
Hmm.
burn ratios. So how much
Yeah.
recurring revenue are you trading off for that growth, and building a pathway so that as you continue to scale, if your business has appropriate gross margins, you should be able to get to a point where you're at some point flipping into profitability, because many of your contracts are recurring, and you have a good level of retention. At that point, you should be able to flip into generating cash flow, but it does take time. So I think it's a long-winded way of saying we've definitely seen a huge shift in the market. Most of our clients now are intently focused on building towards profitability, or at least having a pathway to do so over the next 12 to 20, because that's what investors in the space are demanding.
Yeah, which means then, like you said, I mean, you have to have a focus on efficiency, but you also have to have a focus on quality and retention, and really focusing on making sure that your customers are satisfied, you're retaining them. Because let's face it, in the growth stages or in the early stages, you're kind of always in that hunter mode, aren't you? You're always looking to, grab this and grab that, find the next big elephant. But you've also got to hold on to those other ones that you've already captured.
We see so many deals being underwritten on net dollar retention and gross dollar retention. In fact, I'm working with a client right now that's been with us for 3.5 years. They're going out to raise a funding round, and their investors are purely underwriting this deal on GRR, on gross revenue retention, because they need to know where the clients are that signed with them last year. What are they doing? What percentage of revenue is still around? So the quality of revenue matters deeply. And the quality of revenue, a lot of times, is what's driving a lot of the investment thesis. Because if you're keeping your revenue or your net dollar retention is above 100%, you're growing without any sales, and investors are willing
Mhm.
to pay for that.
Yeah, yeah, no, and it's such a different. It requires a different mindset in many ways, and it is that challenging. How about you in your business? I mean, what are some of the key metrics and measurements that you focus on in order to gauge where your company is going?
Great question. Yeah. So, just a couple of stats on our company. And I know we talked about it at the beginning stage, but we are now. So we're a full service advisory firm focused in growth stage finance. We have an accounting and finance practice that we would call kind of our corporate advisory practice. And that really serves as an embedded finance function for our clients. Sometimes they're too small to have a CFO. Sometimes they have a CFO and they need additional support. We also have a tax advisory group, and we have a transaction advisory group that focuses more on M&A and financial due diligence. So I would say each of those business lines have slightly different dynamics as to how those businesses work. And say our corporate advisory business is more retainer focused. So
Mhm.
retention is a big part of the business because we can work with clients for upwards of 5, 6 years in the out.
Right.
There's opportunity to do so. I wouldn't say that's every client because clients are changing, they're growing. If they're doing really well, maybe they get to a point where they're going to bring their finance function in house, and that's a very good result. But I would say for the corporate business, a lot of the metrics that we're thinking about are ACV, so average contract value.
Mhm.
We've moved up market over the last 24 months, started to work with some later stage companies, some bigger companies. So if we think about ACV, that's very important to us.
Yeah.
We think about retention, just what percentage of our clients or gross dollar retention, or just even gross logo retention, what number of our clients that we have today were with us last year, and what did those clients do. And then we also look into the root cause of potential client churn to make sure that if they are churning, these are factors related that are not related to our level of service or expertise, but potentially external factors as to why that company's no longer working with us. Maybe they weren't able to get funding, maybe that they grew, or maybe they were acquired, in which case we would not be able to. Those are external factors that are out of our control.
Right.
So those are some of the things that we think about and in terms of our own business and growth. And for us, we're a professional services business. A lot of what we do is referral based. How do we find new
Mhm.
leads? It's very, very much driven by the quality of the work that we're doing. If we're doing good work, almost every client knows someone else who needs a great finance function or a great finance team, or an investor that has a portfolio company that needs additional help. So it's really incumbent on us to do excellent work. If we're doing great work, that means that we will grow. We will grow our ecosystem, and we'll grow our client base just through our excellent work that we're doing. So those are some of
Yeah.
the ways that we think about our business um, and its growth. We're starting to do development over the last year or so, and more sort of outreach. So we are starting to
Mhm.
think about professionalizing our own sales function in relation to the current clients that we work with.
Right. And you mentioned moving upstream. So was that a strategic decision, or was that just a factor of the type of business you were attracting?
I think I would say that it's actually a little bit of both. As you do good
Mhm.
work, or if you work with companies that are slightly bigger, they tend to be operating in spaces that other slightly bigger companies are also operating. So I think you sort of have this gravitational pull up market. I also think as our team, when we started, I think I was 30. We had a very young team. So now, as we've grown, our team has gotten more experienced. We've added on and layered on capabilities that has allowed us to be tooled to serve bigger and more complex
Mhm.
clients as well. So I think that that is just a natural progression of our business. As our team has gotten more skilled, we have the ability to sell larger contracts. or attract clients that have a deeper level of complexity. So I think one hand does sort of feed the other, but I think we're seeing a natural progression into a slightly more experienced, slightly larger, slightly more mature client base.
Yeah. And I guess just a final question, I guess then that also then brings back in that focus challenge again, doesn't it? Because as you get larger clients, there is the temptation to do more things with that client that may take you outside of your sweet spot.
Yeah, absolutely, John. I mean, you're hitting the nail on the head. We struggle with this a lot, as we think there's more and more opportunities to do more and more disparate
Hmm.
services within these clients because they're bigger and complex and have more challenges. So it's important for us that we continue to focus. We have been very good. One thing that I think we've done well is listen to our clients and really listen about what things they need and what services need. Because if we hear
Hmm.
recurring themes, hey, do you guys do tax?
Right.
Do you support work? We have our accountant, but they're not really able to suit us. They're not suiting our needs right now. We keep hearing recurring themes. What we've been able to do effectively is build out some more products and services that meet the needs of our clients. But I would say that is more of a client driven sales approach or
Right.
expansion. We're not really going out there and proactively trying to push different business lines. We're really sitting there, we're embedded with our clients, we're working with them day in, day out. If there are areas that just are, we just are hearing this recurring theme about, we think about, is this an area that we can be good at or hire an expert in that we can start a practice area. So
Yeah.
that is something we certainly think about, but we also have to actively fight against keeping focus and working in areas where we have expertise.
Yeah, excellent. Well, listen, thanks very much, Eric. So it's great insights. All of Eric's information is going to be below this video. But before we go, Eric, please do tell people a little bit more about you and Expo Group.
Yeah, sure. Thanks, John. So, like I said, we're a 55-person strategic advisory and consulting group. We're based in New York City. Most of our team is based here in New York as well, which is great. We tend to work with companies that are anywhere from a few $1 million in top line revenue all the way upwards of $100 million in top line revenue. And our areas of focus are around building out great support functions in accounting, finance, and tax. We oftentimes, for smaller businesses, will act as the entire finance team, as the fractional CFOs. For larger
Mhm.
businesses, we'll often work alongside a CFO that might feel overwhelmed or has had a change of control where there's additional requirements on top of them. So we have some different functionality, but generally, I think about our firm as unique, kind of one quiver solution to both extend and bolster and improve the scalability of your business by building out a really high quality finance function.
Excellent. Well, listen, thank you again, Eric. Thank you for watching and listening. I'll see you all again very soon. Thank you.
Thanks so much for having me, John. Thanks for having me, John.
Yeah, absolutely.